Hi, everyone. This is Lynn Musinski-Keck, a tax partner at Withum in the National Tax Service Group, and I'm happy to be with you today to talk about federal taxes. As we all know, it's been a big year, and we've been battling understanding changes in federal tax legislation, excise taxes, interest rates, all obviously important information and how we can optimize our cash and our efficiency for tax purposes. So today we're going to do a broad overview. I will have to ask you to bear with me. We have a diverse group on the webinar, so we're going to be going everywhere from service industries to real estate to tech niche to manufacturing, et cetera. So we're going to touch on all those points throughout today's webinar, and hopefully allowing you to plan accordingly to really maximize tax efficiency and reduce tax impact, cash tax impact in the 2025 taxable year. So the first thing I just like to point out to everyone is the IRS publishes every month or gives an update every month as to their guidance and their priorities. And a lot of the priorities you'll say, yes, that's true. We have been waiting on guidance for that. So the first two items that still remain a priority for the IRS to issue guidance on, which we haven't received a lot of guidance on, has to do with the deduction that's being allowed for qualified tips and the deduction that's being allowed for qualified overtime compensation. We did get temporary regulations regarding qualified tips, which we'll talk about in a second. But from a business perspective, we've been fielding a lot of questions of how are we supposed to be reporting this for 2025? So we'll touch about that today. In addition, you may be aware that certain individuals, meaning limited AGI, are also now allowed to deduct their interest related to qualified passenger vehicle loan interest. And so how is that being reported and how is that being captured for 2025? On top of that, new savings opportunities through the Trump accounts have come through. That is also their priority guidance. And then very significant provisions regarding 199A, bonus depreciation, interest expense limitation, et cetera, are also all on the top 20, or excuse me, top 15 of the priority guidance plan. And so this priority guidance plan has about 121 items. So it's good to see that these are being highlighted. Also included in this plan had to deal with domestic R&E and how we were supposed to apply the new rules under the One Big Beautiful Act. And they, obviously have addressed that in September. So we'll be revisiting those rules as it really is impactful for big business in 2025 going forward. So regarding the individual updates, we're going to focus on those three primary items: tips, overtime compensation, along with interest for qualified vehicles. So as everyone should be aware, this was passed as part of the One Big Beautiful Bill. They've essentially said if you have qualified tips, you are able to deduct up to a specific amount, $25,000. And if in doing so, you're essentially not being taxed on them for federal income tax purposes. One of the items I like to highlight is that is only for federal income tax purposes. They are still subject to Social Security and Medicare. So what we find here is a lot of questions about, well, what is a qualified tip? So they've been very open and gave a lot of examples in the proposed regulations that it's got to be voluntary, right? So it's not that, okay, I had a table come in of 10 and we automatically require an 18% tip. That's not voluntary. They provided an example of, okay, if you're asked at a restaurant, to push the button of 15, 18, or 20%, and there is no 0% option, that's not voluntary. So they really are trying to make sure that it's voluntary. And the other item that was explicit is that it can't be related to an SSTB business. So you might say, Lynn, remind me again what that is. If you're familiar with 199A, which is a 20% deduction that avails itself to certain pass-through entities, there is an exclusion for certain types of businesses. And that's what we call a specified service charter business, also deemed bad businesses for 199A, because they're not going to be allowed that deduction. And so here they said, if you are considered one of those businesses, so it could be medical, it could be performing, they essentially said that we're going to not allow you, if you get tips, to exclude them. What the temporary regulations did come out and say is, okay, well, for example, if you're a pianist and you're receiving a tip, but you're being employed by a hotel, and that hotel indeed is not an SSTB, then you can exclude those tips. So there was further guidance on that. So all welcome guidance in this space through the temporary regs. The other item that's really important is that you have to be identified on a list as to how you fall into one of these specifically identified categories or workers from the Department of Treasury. And so they released that, and they essentially divided all the various people who could potentially exclude tips into 8 brackets. So you'll see them here. And below those categories are more detailed alignment with numbers, etc. For overtime compensation, we don't have as much guidance, right? We don't have temporary regulations, but we're still fielding a lot of questions. The one item that we like to remind people is that it has to be tied back to the overtime compensation required under Section 7 of the Fair Labor Standards Act. While some states might have more detailed overtime compensation or more generous overtime compensation, that does not fall into this exclusion amount. So already you're seeing a delineation between, okay, I'm tying back to the Fair Labor Standards Act, but if I pay more or in excess under my state law, that amount is not going to be included as a reportable qualified overtime compensation. And so we've been fielding a lot of questions on that as well. We're also fielding the question of, okay, well, we understand that we're going to have to look at this and scrutinize this, and we're going to have to, just like I said in my example, determine the difference between what we think is qualified versus non-qualified overtime compensation. They tell us we can use a reasonable method as the employer to separate that for our employees, but we don't understand what a reasonable method is. There's been no guidance provided on that, and that still is the case today. We are still waiting on guidance for that, and obviously highly anticipated, so that W-2s can be issued and be issued correctly. So here's somewhat of a cheat sheet. What they have come out and clearly said is they have no anticipation of changing the 2025 W-2 reporting. They came out early and said that. So essentially, it's becoming more complicated, similar to our Schedule K-1s, right? Where we have the Schedule K-1 and then we have all the statements behind it. We're going to see a W-2, and then they're going to ask, right, that for qualified tips, you're probably reporting them in box 14. But the box 14 is just tips, and a portion of those may be qualified and a portion may not be qualified. And so what's going to happen is you're going to have to provide a separate employee statement trying to help delineate between what's qualified versus non-qualified. That same type of mechanism is going to happen with overtime compensation. And so at this point, I think employers are taking it beyond on behalf of themselves to come up with that reasonable method, or come up with how are we going to be able to make sure we're only reporting overtime compensation that ties back to the federal laws and not the state laws. And how are we analyzing, right, our qualified tip income to make sure it's not related to SSTBs, but also to make sure it's not considered a mandatory payment. So a lot of movements in this area. You would have to think, because of the lack of guidance, that there is going to be some breadth provided in this area. But this is something that you should be aware of when trying to comply with your 2025 W-2 reporting. The other item I would point out is they have come out already and said they are adding specific boxes to the W-2 for 2026 that should help alleviate this reporting and these additional separate statements that have to be attached to the W-2. The other item, for those of you who might be involved in lending money related to qualified passenger vehicle loans, you're sitting there and saying, well, I'm supposed to report something to them. I know I have to essentially allow them to understand what amount is related to a specified passenger vehicle loan. I would highlight in this instance, you are not responsible for telling them that they qualify or don't qualify based on AGI limitations. You're just saying, if you do qualify, this is the amount of interest that should be considered to potentially be deductible. The interest for filing requirements, the interest generally has to be above $600 or more. They provided some transition relief on this particular item, and they've also said you can make a statement available to the individual. just indicating the total amount of interest they received for the 2025 tax year, as we're waiting for a more specific statement or form to be provided for the 2026 tax year. They do say that to the extent that you are reporting out qualified passenger vehicle loan interest, that it must be made available to the individual before January 31st of 2026, which we all realize is coming along very quickly. So those are kind of our individual updates to be aware of that you may or probably already are fielding questions from your employees if you're involved in that type of business line. So the next item we're going to jump into is we're going to talk about all the OBBA changes that impact business. We're going to try to focus on the main three, but we're also going to highlight some other ones that could be very important for people who might be looking to expand or build new manufacturing or processing facilities. So the first one we're going to highlight is domestic research and experimental expenditures. What a road it has been. We have been very active in this fight. And we are excited to see that the OBBA did address the concerns of why would we be requiring, domestic R&E to be capitalized. It kind of flies in the face of wanting R&E to happen in the United States and for growth and intuition or intellectual stimulation to happen here in the U.S. So they essentially, under the OBBA, said for the 2025 taxable year, we're going to put in a code section called 174A, and you're going to be provided options to immediately deduct your 2025 domestic R&E expenditures. When I'm going through all of these discussion points, I always like to highlight foreign R&E expenditures are not included in this. So if you have foreign R&E expenditures, which we tend to see a lot with software development, might be outsourced to a foreign country, and you're directing them, you're telling them how to do the various work, then that would still count as a foreign expenditure. That's still over 15 years, and that has not changed. But regarding domestic R&E, we have two issues that we have to face for the 2025 year, which aren't necessarily bad issues, but we want to be very on top of understanding the overall impact. So the first issue is we had previously capitalized expenditures related to the 2022, 2023, and 2024 taxable year, right? Your rear view mirror. You say, oh, I had to capitalize them in those previous 3 years. What are my options? So within RevProc 2025-28 that was issued this fall, they have provided a variety of options for taxpayers to engage and make sure that they're getting some type of benefit for those capitalized expenditures now in the 2025 or even in the 2024 year, which we'll talk about in a second, to say, they never should have been capitalized. So the first option that is relevant is the small business exception. And this really probably had a lot of discussion with, hopefully with you and your advisors while they're filing your 2024 return. And they essentially reached out and they said, if you're considered a small business, we have, a kind of amplified ability to deduct previously capitalized expenditures more quickly than we do if we're a large business. So what's the definition of a small versus large? So a small business was essentially looking at, okay, if I look at the 2025 taxable year, are my 2024, 2023, and 2022 average gross receipts less than approximately 31 million? And if they are, then I'm a small business. And now I have even more opportunity to decide how I'm going to immediately deduct previously capitalized domestic R&E. So if you're a small business, you were provided with two options. The first option was you could make a method of accounting change and say, for all those previous expenditures that I had not deducted, that were sitting up on the capitalized balance sheet as of 1/1/2024, I'm going to make a method of accounting change in 2024 and deduct all of them. And then I'm also going to deduct all of the 2024 domestic R&E expenditures. So 2024 was being flooded with a very large deduction. And so that was possible. That is generally no longer possible because those change in methods of accounting have to be filed by the extended due date of the tax return. And that has obviously for a calendar year 2024 has passed. But that was kind of one of the options. The other options for small business taxpayer, which is still in existence, is that they're saying, okay, if you're a small business taxpayer, maybe you missed the method of accounting or for whatever reason, you can go back and amend, and you can amend your 24 your 23 and your 2022 tax returns and be able to immediately deduct those R&E expenditures and get a refund. Now, don't jump up and down and say, well, that's perfect. I missed the method of accounting and I'm going to go amend, because there's a lot of traps in that, right? I would say amending is not as easy as you might think if you're in a partnership and you fall under the BBA audit regime. I would say amending can become more complicated if you have people who, partners or S corporation shareholders, who have come in and out of the partnership over the 3-year period, right? So it can get a little bit more complicated. It's definitely something to talk through. The other item I like to raise is, if you file an amendment, the government is shut down. It's the longest shutdown we've had, and the processing of the IRS is stale at this point. So when they get back, they're not only they're going to have to process everything that's been previously submitted and then move forward. It could take a long time for that refund to be provided. So those were your two opportunities if you're a small business. And if you're sitting there saying, Lynn, I'm not a small business, so those don't matter to me, what are my opportunities as a large business? So your opportunities as a large business are, you can look at all your capitalized expenditures that still remain on the balance sheet as of 1/1/2025. And you can say, I'm going to immediately deduct those in the 2025 taxable year, right? So that could be significant. Or I'm going to spread that deduction over 2025 and 2026. Okay. And you might say, Lynn, why would I ever spread that deduction? And we'll talk about it in a little bit, but you're going to see a lot of levers that you're going to be able to pull down this year to maximize deductions for federal income taxes. And what is really important, if the one thing you walk away with, is unlike previous years, right, where we would just say, push it all through, it falls to an all, we'll carry it forward, carry it back. It's a beautiful thing. We now have, under the TCJA, a variety of limitations. So pushing and making a huge NOL this year in 2025 most likely is not a good answer. And you'd say, well, why is that, Lynn? Well, two reasons that are come off the top of my head. If I have a huge NOL and that I'm carrying forward to next year, then now I'm saying, okay, I'm only allowed to use that NOL to offset 80% of my taxable income in the future. What does that mean? 20% of taxable income has to be taxed. Cash out the door. Is there a way that I can manage my deductions so I take some this year and some next year, right? So that I'm not being limited in that NOL. If you sit there as an individual and you say, well, I'm a partnership or an S corporation shareholder, I'm not worried about that. I would say, well, you should be worried about the excess business loss limitation rules. Because if you create $1 million or a $2 million NOL because of all these bonus depreciations and domestic R&E flushing to the bottom line, all that's going to roll up to your tax return, and a married filing joint couple is going to be capped somewhere around $600,000. And they're going to say anything above and beyond that has to flow to next year as an NOL. So all these limitations now really require proper planning to match your dollar of income earned with your deductions. And you don't really want to go much below the income that's earned if possible. So we'll talk about these levers as we walk through today's presentation. So here we're going to talk about, okay, so now I'm going to take all my previously capitalized domestic R&E at the start of 25. You can flush it all through 2025, or you can sit there and say, you know what, I'm going to spread it. I'm going to put half in 2025 and half in 2026. Or you might say, I really don't need the deduction in 2025 and 2026 because of all this bonus depreciation I'm now recouping, or some other large deduction that is being taken. And so you might say, and which is very possible, and you're welcome to do so, I'm not going to do anything. I'm just going to keep it, and I'm going to allow it to continue to amortize over the 5 years that it's required, and I'm going to move on. So lots of options to deal with the previously capitalized 174 domestic R&E. So now that's the past. That's how we're going to deal with the past. Now we're looking in the current state in 2025. I have domestic R&E. What can I do with it? So I think we all are aware, right, that now we can absolutely just say, flush it, immediately expense it. We're going to immediately take that. If I immediately take my 2025 domestic R&E, that's not aligned to how I deal with my previous capitalized amounts. I don't have to be the same on both of these. Alternatively, I could also say, you know what, I will take the domestic R&E and I will capitalize it and take it 5 years, in which and not start taking the amortization over 5 years until the first year I receive benefit. Great. you can do that as well. The only thing I always caution taxpayers is to realize that that doesn't mean you get to immediately amortize it over 5 years. It does mean that you have to realize benefit, which sometimes is tied to commercial use, of when you can start amortizing it over 5 years. And there is even a third alternative that says, okay, I don't want to immediately expense it. I don't want to wait for it to be commercialized for that 5 year period to start. I'm just going to elect to capitalize it over 10 years. That's an option as well. So all these levers can be pulled down. And not only can they be pulled down based on year, but even within the 2025 taxable year, you might have a big item that you're going to say, I'm going to immediately expense that. And then you might have a bunch of other items that you're required to, that you could immediately expense, but you're going to say, no, I'm going to take that over 10 years. So you can play within the assets within the year. So this causes a lot of flexibility and a lot of great planning opportunities for clients. Okay. So we got done with 174 domestic RD. I hope you're as excited as I am that that's behind us. So hopefully very soon behind us. And now we're moving on to bonus depreciation. So all of us kind of went, ugh, when they put the effective date of when you could claim 100% bonus depreciation as January 19th of 2025. So they essentially say that if you acquired property after January 19th of 2025, then you can elect to essentially take 100% bonus depreciation on it. And so now, and we've done this before, so we all know how to do it. We're zoning in and we're concentrating on what does it mean to acquire property after January 19th of 2025. And so really look into this. And I'm not saying look into this for like a $5,000 asset, but if you bought a $500,000 asset or $1 million, something that is significant to your business, drill your tax accountant and your business advisors for this question, because there are lots of rules and exceptions amongst those rules regarding what does it mean to acquire an asset. So here, what we learned is the first rule of thumb is what does it mean to acquire? And they essentially say, we're going to say you acquired an asset pursuant to a written binding contract, which there's a definition of a written binding contract all on its own, at the later of one of these items occurred. So we're going to say you have a binding written contract. It's going to be deemed as acquisition the later of when the contract was entered into, or the contract was enforceable under state law, when all the cancellation periods end, or all conditions subject to contingency clause are satisfied. So you could see, right, that there could be a contract that you're entered into on January 1st, but it might not have been acquired for purposes because there was a contingency clause that wasn't lifted until January 30th, right? So those are all things that your legal team or your business advisors, your tax advisors can help you look through and really assess, do I get the 100% or don't I? The other big exception I like to point out to people is self-constructed property, right? So what if I entered into a binding agreement to build something, and I entered into it in December of 2024, but the actual construction of the project didn't happen until March? Are you telling me because I had a binding agreement in December and nothing happened that I'm now excluded from 100% bonus depreciation? And there's exceptions. So this exception says, not necessarily, right? And this is why we say we look into the detail. The acquisition date for self-constructed property is the date they say that you manufacture, construct, or produce the property. So obviously in that example, I'm not manufacturing, constructing, or producing the property until March. So I could say my acquisition date is after the January 19th deadline. And then within that, so this is just, it gets even more complicated, is within that, say I'm self-constructing property, and now I have a large piece of equipment coming in as part of that self-constructed property. Well, could we argue that, yes, the entire self-constructed property is not considered bonus eligible, but maybe this large piece of equipment, a component of the larger self-constructed property, is eligible? And the answer to that is yes, maybe. So all of this just to say, don't get caught up necessarily just on when that date the contract was signed. There's a lot of rules regarding this that have been out for a while. And so we really need to focus and concentrate on understanding this to make sure we're optimizing our bonus depreciation. And then for some of you who say, Lynn, I really don't want bonus depreciation this year because I'm going to have those huge 174 expenditures, those 174 pre-capitalized amounts. That amortization amount is going to add to my EBITDA. So my interest expense is going to be higher this year. And I don't need bonus depreciation this year. And you'd say, but I would rather not go back to traditional makers. Is there some type of bridge in between? And the answer to that is yes. So as part of the law, only for the 2025 taxable year, the first taxable year after which the the first taxable year ending after the bill was passed, they essentially said, all right, we know that you might not want 100%. We know you might have preferred and would rather hold steady with the 40% you were expecting for the year. So for the 2025 taxable calendar year only, you can essentially elect to say, I don't want 100% bonus, I want 40% bonus. So hopefully, as we're going through all these items, you're noticing, wow, you can really make up. I hate to use the word make up, but you can really choose different options to get the taxable income number you want for the 2025 taxable year. Next slide. The other item that we always like to point out as well is there's this new Fathom election, which I've never seen in my lifetime, that says you have real property. That real property is production property. We're going to allow you to immediately expense it instead of taking it over a long period of life. You're right, 39 years. And so this is a brand new section. Again, reiterates the importance that the government is putting on production in the United States and wanting to bring things home into the United States for production purposes. And they said, you know what, if you make a manufacturing facility or a production facility, including agricultural production or chemical production, or if you're refining a product, then you can essentially not have to depreciate that building, but instead we will allow you to immediately expense it. And so you might say, wow, that's amazing. Now there's rules, right? Which we've dealt with in the CHIPS Act and we've dealt with other, where we have to separate what is truly related to manufacturing versus what is truly related to administrative offices, back sales activities, et cetera. But there's a big portion of that you might be able to immediately drop to the bottom line. And this is a really new concept, and we've been hearing a lot of misnomers about it. So some people will say to me, Lynn, but I heard you have to build a brand new facility. We're not going to build a brand new facility. We're going to go out and we're going to get a used facility and we're going to use it towards production. And so I like to remind everybody, it doesn't have to be brand new, right? Brand new is on the left. Those are your requirements. But essentially it could also be acquired or used. And so what the main distinction is between new versus acquired or used is they say you have to all follow kind of the same pieces. It was acquired or built after January 19th of 2025 and before January 1st of 2029. But for your used property, they say, okay, as long as that property wasn't used in qualified production between January 1st of 2021 and ending on May 12th of 2025. So within that time period, if that was used for retail, if that was used for food service, if that was used for anything else other than production, then you are allowed to act as if this is a new qualified production property, or you're just allowed to say it's a qualified production property for purposes of immediately expensing the portion related to the real property. So I think a lot of people are missing the right side. And so these are, again, great questions to be asking and discussing if you've had major purchases this year of real property for manufacturing or production. So here we're just going to take some time and kind of go through, okay, we just went through there. There's a lot of business provisions that we went through. And so at a high level, this kind of helps you track, okay, what did we just talk about and what should I be focusing on for the 2025 taxable year? So domestic R&E, we understand if you're a small business, you had some options in 2024. If you weren't a small business, you're really focusing on the 2025 taxable year. You're going to decide, what am I doing with those 2025 expenditures this year? And what am I doing with all the previous amounts that are still capitalized at the beginning of 2025? Am I going to immediately deduct them in 2025? Am I going to spread them over 2 years? Or am I going to just keep them amortizing them over 5 years and call it a day? So lots of decisions to make in that bucket. The other item that gets everyone excited, I think, I haven't heard one person complain at least, is that now when we look at our interest expense limitation rules, our 30% is applied to earn essentially earnings before income tax plus depreciation and amortization, what we like to refer to as EBITDA, and it is not applied on EBIT. So we're getting a much larger base to apply that 30%, which means we should be allowed much more interest expense. And what you're going to find is, remember, if you elect for all that previously capitalized as of 1/1/1 to immediately be deducted in 2025, that's going to be deemed as amortization, and that's going to give you a huge add back for interest expense limitation. So what does that mean? If you were disallowed in previous years when it was being based on EBIT, you're likely going to free up a significant amount of interest expense that was disallowed. So again, that's a positive attribute that you'll be utilizing, something to be aware of, and make sure that it's being utilized effectively. We just spent a lot of time on bonus depreciation. Watch out for that, particular date acquired after January 19th. Don't just look at the contract date. Ask your advisors to dig in a little bit more if you really need the 100% bonus depreciation. Alternatively, if you're saying, I really don't want the 100%, I really was counting on just using the 40% that was this year, you can elect to do that as well. So these are all different types of options you can make while calculating your taxable income for 2025. We went through qualified production property. If you have it, if you think you might have it, if you could benefit from it, meaning it's not going to drive you into a large NOL, or even if it is going to drive you into a large NOL, model it out, plan it out, make sure that you're not leaving good cash tax money with the federal government instead of with your business. Other items I would point out, 179 expensing got a nice jolt, right? So you might say, well, I don't want to take bonus depreciation because of the impact it has and on the variety of states that I file in. I'd rather take 179 if I can. And so you should know that the maximum deduction increased to 2.5 million. And you don't start reducing that 2.5 million unless you put 179 property in for the year above 4 million. So sometimes that works. Other times it doesn't. We have lots of companies who say, well, I easily put in more than 6.5. But for the companies that does work, that should be your first point, right? Is to stop at the 179 and explore it before going on to bonus depreciation. The other big item that I don't think is getting a lot of attention is charitable contributions. And I'm just going to explain it to the best of my ability, and that we all know previously and still in effect for 2025, the reason I'm telling you, you may want to escalate your charitable contributions into 2025 because of the change that will be occurring in 2026. So in 2025, if you're a C corporation, they're still going to say, we limit your charitable contributions to 10% of your taxable income generally, right? So we would say if I have $1 million, then I'm going to be allowed a deduction up to $100,000. Okay, perfect. However, next year, not only are they going to cap at $100,000, they're also going to say, you're not going to get the first 1%, right? So in that same example, they're going to say, okay, you have to clear 1% of your taxable income, which would be $10,000. Okay, you cleared that. Now you're still capped at the $100,000. So next year it's only going to be $90,000, meaning you have to exceed 1% to be able to get the deduction, and you're still only being allowed to get to 10%. Now, if you don't give a lot of charitable contribution and don't even exceed 1% of taxable income, you probably want to push them in this year, right? Because essentially they're going to be wiped out next year because you're never even going to exceed 1% of your taxable income. Alternatively, if you say, we give some big items out, right? And we would rather not be subject to that 1% floor, and we'd rather get the full 10%, then that's something you want to push in as well. So I think more and more on the individual side, you might have seen this when people talked about itemizing deductions. They talked about using donor advised funds for their charitable contributions. So you would push all 2 or 3 years worth of charitable contributions into a donor advised fund when you knew you wanted to take the itemized deduction. I could see corporations somewhat for large charitable contributions, at least pairing them into multiple years so that once they exceed that 1%, they're not having to exceed it every single year, but they're hitting it 1 year and then maximizing it out. So this is a great planning opportunity as well. And I would encourage, we do have some clients who make major donations each year. This is something to bring up in your tax planning and see, does it make sense to escalate any of those charitable contributions? Okay. So this just goes back to my previous point we talked about. It is going to be really important for us to understand the matching principle and that we're not going to try to drive us into a huge NOL, because the years of fully caring for the NOL or the years of being able to utilize a large loss on your individual tax return without limitation is gone, right? And so to the extent possible, we're going to work now in our planning with our business and tax advisors to say, okay, for every dollar of income that I brought in, let's try to make sure that I'm offsetting it through these various levers to make sure I'm depleting it and getting it to zero, but not so that I'm driving it so far negative that I'm going to be limited, in future years and being able to use it and immediately cause a cash impact. So how do I do that? Maybe I don't take all the previously capitalized 174 expenditures this year. Maybe I spread it over 2 years. The other item, maybe I don't take all of my current 2025 174 R&E expenditures this year. Maybe I take some over 10 years and I take some currently this year. I mix it up. Maybe I say, I'm not going to elect into 100% bonus depreciation. I'm only going to elect into 40%. And all those items, I would say, I would be careful, right? That previously capitalized amount, that's going to act as amortization, raise your EBITDA for 163J. Your bonus depreciation is going to raise your EBITDA for 163J. So along with limiting those, you might be limiting your interest expense and getting to a better number for you this year that you can further exploit next year. So all of these are different items, ideas. Normally in the past, we looked at this as a change in method of accounting was a common area that we would review to try to, look at the ways that we could adjust taxable income in the year. This year we have a lot of options, so I would just say don't let it go by without modeling and really pushing out how you can be effective in this space. So great question. Someone asked about the 1% floor for charitable contributions. Thanks for the questions. We do enjoy them. So the 1% floor only applies to C corporations. So for S corporations and for partnerships, you may recall that the charitable contributions are a separately stated item on the K-1s. And so essentially it just gets brought up into the individual return, reported on the Schedule A, and is under individual limitations, right? So cash contributions can't exceed, I still think it's 60% of AGI. It's 60 or 50% of AGI. You can check on that. But that they would still get limited at the individual level, but not that 1% floor and 10% max is only at the C corporation level. Great question. Thanks for asking. Okay. So give me 1 second. I'm going to get a drink of water. I'm a little under the weather, so we'll see if my voice can keep up with me. The other item we've been talking a lot to our clients about, and we've been seeing a lot in the news, and we've been getting a lot of emails from our clients saying, is this true? Like, is this reality? Is the purchase of clean energy credits for not a deferral of tax, but for really an elimination of tax. And so we've done this. We've probably helped our clients over the last couple of years with buying and purchasing over $100 million of credits. And obviously going north as we continue for 2025. But this is an important concept that understood is based on people's comfortability in doing such a transaction. But I think the biggest hurdle I had when we first started talking to our clients about this after the Inflation Reduction Act is I want you to understand this is not with them being creative, right? This is in reality, there's regulations, there's IRS FAQs, there's forms. This is the IRS and Congress have pushed out this capability that has made it a multi-billion-dollar industry for people who are saying, okay, I want to get involved in this. So before we jump in, you might say, well, why would they ever do this? So let's talk about what a clean energy credit is. So a clean energy credit is similar to a general business credit. So you might take an R&D credit. That's similar to a clean energy credit. And what the IRS or what the Inflation Reduction Act did, right, whether right, wrong, or you agree or disagree, they were trying to get back into the French Climate Accord and decrease emissions by X amount within a certain time period. And when you looked at that time period and the ability to reduce the greenhouse gas emissions, you couldn't do it alone by the government sitting there and saying, "Here's a grant," right? Or here's $100 million, or here's $500 million to build your project. When it was looked at, they said, not only do we need grants, which we'll continue to do, or maybe at that time even provide more grants, but we need for profit, and we need not for profit, and we need governmental, and we need Indian tribunals, and we need everyone to be involved in this kind of effort. And so how they arrange that without having to be the one who's monitoring it with various grant programs is they said, for the first time in history, I mean, to me, it's still mind blowing. For the first time in history, they said to all the not for profits, Indian tribunals, governmental entities, they said, you know what? If you invest in a clean energy project, we never before have allowed you to get a refund in relation to that credit. You always had to generate taxable income, or UBTI, unrelated business taxable income. For the first time in history, they said, now you don't, and we'll refund you, right, for a portion of that credit. So that's where all our not-for-profits, government agencies, very active in the space. We're very active with them. On the other hand, though, they also said, you know what? Previously, for large investors, think of insurance companies, think of large banks, to get involved with clean energy credits, or just in general credits, energy credits, you would have these institutional investors come in with a developer who could make these credits, and they would do something of a flipped partnership structure, for example, a complicated partnership structure. So at the end of the day, these institutional investors were grabbing onto the credits. When you think about how that was done, that was being done for a very specified market, right? You needed to know how to do it. You needed to have legal, accounting, and you needed to have a complicated structure that was being monitored. And what that meant is that the middle market, or the middle to upper market that wasn't in that bandwidth, weren't allowed to come in on the game. So now all of a sudden, under the Inflation Reduction Act, they've said, you know what? We're not going to make it be in these complicated partnership structures. If developer A has $5 million of credits that it wants to sell, and C Corporation over here says, I have a $5 million, or a little bit more, let's say I have a $7.5 million tax liability, and I'd like to buy those $5 million credits, I don't need to be involved in the partnership structure. Now, all I have to do is say to them, I want to buy them. That $5 million, you're going to buy it. And now all of a sudden, you are going to have an immediate tax benefit, because guess what? You're not going to buy them for $5 million. You're going to buy them for 91 cents on the dollar, 92 cents on the dollar. So all of a sudden, these discounts, right, this 8% discount, this 7% discount, is now applying to you, even though the government is still getting their $5 million of tax. So this is the big aha moment in the Inflation Reduction Act. So we always like to remind clients that this is out there. If you go and have a large tax liability and say, hey, I would like to purchase those credits, and the seller sells them to you, there's no taxable income or tax deduction. It's a nothing. It's a wash of nothing. So for example, the fact that you bought them for less, you don't have to recognize anything. You don't get to recognize expense. On the other side, they don't get to recognize a loss. They don't recognize the income. And so this is a common way that some corporations are dealing with shielding their requirement to make estimated tax payments, right? Because you can also go into these credits later in the year than when your estimated tax payments are being due. So things to be aware of. Once you make an election to transfer a credit, meaning you buy the credit, it's irrevocable. So the seller can't say, yep, I agree, and then revoke it. It doesn't happen that way. The transfer, the seller and the buyer must be unrelated. And once you transfer the credit, you're done. Meaning I can't buy a credit and then now go on and try to transfer it again. That's not allowable. You can only transfer the credit once. Um, in addition, what you should understand, which is why this is a unique, when you purchase these credits, the purchaser now is taking responsibility for these credits for defense against the Internal Revenue Service. So that's why it's very important that you have your tax advisors in doing the due diligence. You have a variety of different ways that people might feel more secure. So obviously indemnity agreements, but you also see insurance agreements in these examples, where essentially they're protecting themselves for anything that could go awry regarding the energy credit. So here, we're just going to go through a brief example. And the example shows, okay, I have a tax liability of 27 million. If you all are familiar with general business credits, they normally can only offset about 75% of your tax liability. So you still have to pay cash in of 25%. But here, what you're going to notice is that these additional cash payments that you are required to make on June 15th, December 15th, and December 15th for C corporations, guess what? You're not going to have to necessarily make them. What the IRS says is if you show an intention to buy a credit, you don't have to make your estimated tax payments on time, and you will not be subject to penalties and interest, provided you do indeed purchase the credit before you file your tax return. So that means that you can avoid the June 15th, September 15th payment, right, potentially, and then purchase your credit in the last quarter of the 2025 taxable year. And you've been able to handle or hang on to $13 million more during the taxable year because of the fact that you didn't go after the actual credit and pay for the clean energy credit until the fourth quarter. So I'm not going to get too much in detail of this, but you can spend time on this example, reach out with questions. But essentially, it's showing not only is this particular client having a savings, right, of $1.4 million because they received a 7% discount on the credit that they needed to purchase, but they also are generating savings on the time value of money and the fact that $6.7 million is not going out on June 15th, but I'm able to hold it for a longer period of time before I actually pay out my clean energy credits. The common question I get consistently is, Lynn, please explain to me what is the ideal market for this, right? So what if I don't have a $27 million liability? I can tell you we've done these for as small as 2 million, past 30 million. So somewhere within that range. I think 5 million is a sweet spot, but to dip your toe in at 2 million, it has been successful as well. So this is a new way. If you're sitting there saying, hey, I'm a partnership or an S Corp, can I do this too? It's more complicated. And where we've seen the really alignment of being able to buy these clean energy credits, it's really pushed to C corporations or potentially to high net worth individuals who generate a lot of passive income. And when I say passive, I don't mean like dividends and investment income. I mean income that they are receiving through a K-1 where they are not materially participating. So this is an area that I always like to point out doesn't defer tax, but completely eliminates tax, right? And the fact that they would not have to pay, in this example, they're saving about $1.6 million, and they would not have to pay that $1.6 million at all in the future. So I'm going to, if you want to dig more in, the one other item I like to point out to people who are learning about this topic is they think, well, yeah, Lynn, well, I'm going to go buy and I'm going to buy it at 7% discount, but then I'm going to be stuck paying all these additional fees like due diligence, drafting the SPA, drafting the terms agreement, insurance, et cetera. And what you'll see in the vast majority of these deals is a lot of that cost falls to the seller. Seller's going to pay for the insurance. Seller pays the brokerage fees. The seller has to draft the SPA, the sales purchase agreement. They have to draft the terms, and they also have to provide, obviously, the variety of information to get comfortable with the position with the credit. As the buyer, you do have to perform due diligence on your credit. That's when your tax advisor, your tax firm steps in. For the due diligence on your credit, sometimes that can be picked up by the seller. You would say, well, I want you to pick up my due diligence costs. And then from a legal perspective, you're only engaging for someone to review the terms agreement and to review the SPA agreement. So the legal from a buyer perspective is minimal because you're not creating it, right? You're just reviewing it and providing commentary. Okay. All right, I'm going to come over here and check out a few more questions that have come in. Yep. So someone said if a C corporation is in an NOL situation, are charitable deductions not deductible? So I guess I would. So the answer is that C corporations are only allowed charitable deductions to the extent, right, that don't exceed 10% of taxable income. So to the extent that you have no taxable income, your charitable deduction, I agree with you, would not be deductible. Are your clients seeing refund delays because of shutdown where there is a refund due? I personally don't know that. To be honest with you, I know we pushed while the government was still open. There was a push to say if we're going to take certain deductions, we don't want to do it via amendment because of the impeding government shutdown. We want to push it through as a regular filing, so through their 2024 tax return, because those get processed when the government is open. They should be processed in a 10 to 12 week period versus amendments can take 6 to 9 months. So that was, that was part of the decision making process or the discussion process with our clients when we were trying to understand what's the best path forward for them. Okay. And so we've covered a lot. We're getting closer to the finish line. We've covered obviously a lot of business provisions, individual provisions, but important provisions on how do I report this to these individuals regarding my W-2 with overtime pay and tip compensation. We also have spent, I feel like, a significant amount of time in understanding that there's a lot of different ways that we can accelerate deductions this year besides just a change in method of accounting. And so we should be analyzing those specifically, but also realizing that there are additional limitations that will apply to NOLs that we don't necessarily want to get involved with if possible. So analyzing how we can steadily deduct against our income as opposed to driving a significant loss of income in 2025. We talked about an elimination provision where we could go out and say we have a large tax liability. We're interested in purchasing these clean energy credits. As I've said, really a large industry. There was kind of a back off of this particular topic when waiting for the OBBA. Many people were concerned that it would be eliminated. It was not eliminated. It is alive and well. So that's something that we can feel confident in doing over the next 10 years, that's still going to be a viable option. And now I'm going to talk a little bit about the change in qualified opportunity zones, which again is another topic that I feel when I talk to even accountants, general accountants, that is kind of under the radar. People weren't necessarily aware that this was occurring. So specifically, we're going to talk about the current law, and then I'm going to tell you what is new under the OBBA. And when we talk about the new law, it doesn't apply until 2026. So capital gains, right, that you're reinvesting within the 2026 year. But why I bring it up, and I think it's important, is we're close enough to the end of the year that you probably have the flexibility to determine when are you going to trigger that capital gain. So if you're not aware of just the overall, what the qualified opportunity funds or zones were or are, is it was a provision put back into law that essentially allows, if I trigger a large capital gain, in this example, we have it being triggered in 2019, I could reinvest it within 180 days. It provided it was reinvested in a qualified opportunity fund. And to the extent it was reinvested within the 180 days, then I didn't have to pick up my tax on it. So that was a beautiful thing, right? That's a deferral provision. And then essentially what would happen is if I later on sold it, right, before the designated automatic deemed sale by the IRS, then I would have to pick up the gain. So if I only held it for 2 years, I would have to pick up the gain on that year in which I sold. But to the extent you held it, certain attributes started to be provided for you. So say I had a $1.5 million long-term cap gain. I invested it within 180 days. All of a sudden, I've held it for 5 years. My basis is zero, right? At the beginning of my investment. All of a sudden, they say, oh, if you've held it for 5 years, we're going to give you a basis of 5% of your overall investment. So 5% of the $1.5 million. So you've just decreased, like if you sell it in year 6, right? You've just been able to eliminate 10% of the gain. Then they added a sweetener and said, if you hold it for 7 years, we're going to up that basis amount to not giving you 10%, but to give you an additional 5%. So now all of a sudden, 15% of that long-term cap gain you invested is turned into basis. So if you sell it, won't be taxed and is eliminated, right? So we're saying, okay, I see where this is going. And then ultimately, we had a specific cutoff date that they said as of 12/31 of 2026, whether or not you actually sold it or not, we're going to trigger that gain. And you would say, well, to the extent I've held it for 7 years, automatically 15% of that gain is not going to be taxable. And I'm going to trigger that gain and I'm going to pay tax on it in the 2026 taxable year. Then they went on to say, if you hold it for 10 years and then you have a disposition, we're not going to tax the difference between the appreciation that happened at the end of 2026 until the ultimate year you sold it. So this was not a short-term play, right? This was a long-term play. And if you know anything about qualified opportunity funds or zone businesses, it's really focused into areas of need that we're pushing economy or manufacturing or production business activity into. And so when people, heard about this back in 2022 or 23 or 2019, hopefully, people were excited. And people also recognized that, wow, a lot of these zones that were designated, specifically something called the contiguous areas, were not what you would have thought as, low income areas. They were essentially areas that maybe could have multi-million-dollar homes on, right? It was not as restrictive as one might have anticipated. And so we had a lot of clients involved in this. Over the last 2 years, when clients come to us and say, I'm triggering this large long-term cap gain, is there anything I can do? And we would say, oh, well, there's still this option with the Qualified Opportunity Fund. They would say, yeah, but that only gives me deferral until the end of 26, right? And so you could see more and more people kind of walking away from it, mainly for the fact that it had a completion date, an end date, and it was going to terminate. So what the OBBA did is they recognized that and they said, okay, well, we're going to extend the Qualified Opportunity Zone program, and we're not going to have a permanent date of December 31st, 2036, right? We're going to essentially keep this program ongoing. And then, so that's a plus. And then they said for every 10 years, the governors will propose new qualified opportunity zones. So meaning effective January 1st, 2027, we'll have a new designation of qualified opportunity zones that are being picked by governors now on July 1st of 2026. So the nice thing about this is I won't have a client again coming to me and saying, yeah, but that's only open until the end of 2026, because essentially this is going to be a permanent option. Now, there are already questions of saying, well, what if I invested in year 6 and then at year 10, the designation changes and then I'm still involved in my path of 10 years? How does that work? We don't know yet. So we're still waiting on regulations to say, well, what if it was an opportunity zone for your first 5 years, but not your last 3 years or your last 5 years, et cetera? We don't have that information yet, but the power is to know, yes, these are still applying. And to the extent that you want some basis reductions, you might not be saying, I want to invest in a qualified opportunity fund today with that mandatory deemed sale in 2026. I might wait and look to invest in 2027. So we're looking to trigger a capital gain after December 31st of 2026. Unlike the first opportunity, remember the first opportunity said after 5 years, you'd get a 10% increase. After 7 years, you get an additional 5 for 15%. They don't have that. They simply simplified it and said after 5 years, we're going to give you a 10% increase. But on top of this, they said, you know what? We want to support and increase investment in qualified rural opportunity funds. And they said the qualified rural opportunity funds, and we'll talk about what those mean in a second, we're going to not give you a 10% basis increase after a 5-year investment. We're going to give you a 30%. And remember, this 10% and 30% basis increase after a 5-year hold is an elimination provision. I'm never going to have to pay that 10% or 30% tax or amount on the long-term capital gain that I invested. It just disappears. So that's significant. Then, unlike the first option where they said we're going to have a mandatory tax that you have to pay as of December 31st, 2026, they're saying, no, you're going to have to recognize the mandatory tax if you haven't sold it yet after 5 years. So we're looking at a 5-year runway. We're saying after that 5-year runway, you're going to have to pay the tax, but you will either have a basis increase of 10% or 30%, depending on your investment. And then we come down to the similar, you can increase your basis to fair market value if you hold it for at least 10 years. So a lot of people are excited to see this program continuing. So this is just a chart that kind of shows you we don't have that 7-year mark. We still have the initial investment. We still have deferral, 10% in year 5 or 30% if we're in a rural area. And then obviously no tax due to the extent that we've held it for 10 years. Things have changed a bit. So one of the biggest things, which I talked to you about a little bit earlier, the contiguous track was quite useful in the previous qualified opportunity zone law. They have removed that contiguous track rule. So now I can't have a track that abuts a qualified opportunity zone that may still qualify, that no longer is available. And then essentially what they said is previously we were linked to the new markets tax credit in determining, what type of area would qualify for a qualified opportunity zone. They kept the 20%, but they added a medium family income to fall under the poverty rate must be at least 20%. And then they also said that the other alternative is that the median family income does not exceed 70% of the applicable state or metropolitan area. Before it was 80%. So tweaks in there that will tighten up the ability for certain areas to be designated. But the more exciting part, for me at least, I'm from a very rural area, is this creation of the Qualified Rural Opportunity Fund. So now they're saying, okay, well, we're going to add a significant adder. We're going to jump from 10% of a basis protection to 30% after a 5-year holding period if you're in a rural area, which is defined as a city or a town with a population of greater than 50,000 and an urbanized area adjacent to a city or town with a population in excess of 50,000. And so not only do they say that now qualifies as a rural area, but they now also say that to be considered a rural area, you used to have substantial improvement be 100% of what you invested, and now they're essentially lowering that to 50%. So you don't have to, you won't have to put as much money into the rural area as you would in a regular qualified opportunity fund. So lots of changes there to be aware of that we should make sure that we're keeping track of. And I think, okay, I am on to questions. So I'm going to go, if you haven't already, put your questions in the chat. They're getting ciphered to me. I'm going to go back and review some of the questions that are being asked currently. Okay, so one of the questions says, how does it work if you are an LLC taxed as a partnership selling to a corporation? Is it sold at the entity level? So that's a great question. I think what I'm gleaning from that question is if I'm a partnership, meaning that I'm the one who's actually creating the credit, and I'm going to sell it to C Corp, which is common. How does that work? So absolutely, you can do that. You should do that. It's the C Corporation who's going to claim the credit on their tax return. From a partnership level, you just have to make sure the ability to sell the credit is dependent on obviously the creation of the credit, but also some at-risk basis rules that you probably want to review. to make sure the credit's not limited from the partnership. And then essentially what happens, similar to if you remember PPP, you're going to be reporting tax exempt income when you receive the cash. And that tax exempt income will adjust the basis in the partner's basis in the partnership. But there are no limitations for the partner or the S corp to sell from selling those clean energy credits. What we find is that essentially, if you're a partnership or S corp that wants to try to buy them, there's a whole tax advisor article that's out there that I wrote. Essentially, they come in as tax credits in which you are not materially participating in, so passive credits. And those passive credits, obviously, if I'm active in the S corp or active in the partnership, don't help me offset my partnership income. They really only help me offset. Passive income, and if I don't have passive income, it's a very bad idea. So we've been trying to get the word out on how that kind of interacts. We've also had some clients send us information and say, hey, they're selling this credit and it's only 60 cents on the dollar for their individual returns. I should buy it. This is a no-brainer, blah, 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 blah. And we kind of have to walk through them. If deals are too good to be true, then they probably are not true. And so that is the case with those kind of schemes. And the IRS has put out a variety of notices on that this has been happening. I think similar on a lesser scale to sometimes the craziness that surrounded ERC. They're essentially saying, no, right? That if you're a passive, like if I'm an individual and I'm looking to purchase credits, know that the credits you're going to individually purchase are only going to offset passive income. So if I'm a W-2 individual with some dividends and some interest and I purchase credits, those credits aren't going to do anything for me from a federal tax liability perspective. So it gets more complicated. That's why I said it gets more complicated if you have partnerships and S corporations buying credits, but it's not that complicated if they're the ones selling it. The only item I always remind people is there has to be at-risk basis for up to the amount the partnership is trying to sell. So that's a great question. Let's see what else. Other items some people have asked is, do you know what's open versus what's not open in the IRS due to the government shutdown? There is a great article that we can provide that essentially goes through all the various items of the IRS and what's open versus not open. I think essentially they said their workforce for people who had to still report, I think it's only at 46% right now based on the government shutdown. And right now, as everyone is aware, they have not said anything about delaying the deadline, but there is fear because the longer this goes, the more and more they have to go through all the submitted items that have been occurring since the government shutdown, even before they get into the current 2025 filing season. And then also another great point, which I didn't even think of, they do a massive hiring in this time period for the 2025 filing season in like October, November, and December. And so they have not been able to do those hires for the filing season. And so that could be very limiting as well. Too expensive. Okay, I have one question. If you have NOLs historically and in the immediate future, any downside to elect to expense domestic R&D in 2025 to avoid a change in method of accounting in the future? There's a 5-year waiting automatic change if you elect to capitalize. So want to avoid blockers in the future. Also, okay, so I would say if I'm in a significant NOL position now, meaning I'm not expecting to pay tax in the next few years, I would not feel the rush to accelerate my capitalized amounts related to future years. I would point out though that for 2025, that has the ability to immediately deduct the previous capitalized expenditures, no rush. If I'm in the significant NOLs, I'm not going to do that. I'm going to let those ride 5 years. And this is just in general. I haven't seen your specific information. And then for 2025, what I would say is if I'm in an NOL, I don't really want those to push down. I don't need them to push down right away, right? So I might look at I would forecast my NOL out and see how far my NOL is going, but doesn't make sense for me to say I'm not going to immediately deduct those. I mean, I'm going to take them over 5 years for the 2025 domestic R&E, and I'm going to take them at the time in which I receive benefit over 5 years, or I'm going to take them over 10 years under 59E. And the other thing I would say to you, and this is where it gets into the nitty gritty, it's on an asset by asset basis. So you don't have to, it's not an all or nothing. Like I need to do it all for 10 years and not at all. It's an asset by asset basis and can be analyzed. If I'm in a solid NOL position, plus if I'm in and NOLs pre TCJA NOLs that aren't limited, right, 100% offset, then I really have no motivation to escalate that expense. So can you sell that? So someone said, if you invested in a QOF in 2022, then at 12/31/26 is taxable. Can you sell that interest in 2026 and invest after 2027? Is the gain deferred? So yeah, that's the interpretation of. So remember, if I'm in a QOF right now, they're saying, okay, whether or not you sell it or not, you have a mandatory taxation event at the end of 2026. And so now you're saying, okay, I'm going to have to recognize the gain. Now, just because you have to recognize the gain doesn't mean you sold the property, because you might say, well, I want to hold on to that property for 10 years, right? And then after the 10 years, any appreciation from 2026 onward to when I sell it is not taxable. So you have to debate, is it worth it for me to just to hang on to it for the 10-year period for future appreciation to avoid taxation? Or alternatively, to your point, do I just really sell it then on 12/31/26 and try to roll over my long-term capital gains into the new qualified opportunity fund in 2027? That's a decision process you would have to make based on what the qualified opportunity zone is doing. The other thing I would point out is, remember, the only amount that can be rolled over is the taxable amount. So if you had $1 million investment and you've held it for 7 years, you're not getting the long-term cap gain tax on the million. You're only getting long-term cap gain tax on the million less the 15%, right? Because you got that 15% basis bump up. And so that's the amount that could roll over within the 180-day time period to be reinvested. So I think that was the question. Can you explain how clean energy credits were impacted by OBBB? Yeah, great question. So I probably should have had a whole slide deck on this. So clean energy credits, which one? So I'll start with some common ones that we've seen, and we've been working especially with governmental and not-for-profits that have kind of gone away. So one had to do with the commercial vehicle. So the commercial vehicle went away in September of 2020. I believe it's 2025. And I wish I had the slide up in front of me, but essentially they said, if you have not acquired a vehicle before September of this year, then you no longer will be allowed to claim the commercial vehicle credit. What a lot of people didn't know is how they defined acquired. The IRS came out with an FAQ sheet, and it was very, I don't know, I didn't think it was publicized enough, but they essentially said, you don't need to have it on your lot for it to be deemed acquired. You need to be in a binding written contract and have paid some amount down for it to be acquired. So meaning, as long as I paid some amount down for my commercial electric vehicle prior to, I think it's September 30th, then I'm essentially allowed to count that towards the commercial clean vehicle credit, regardless of when I actually receive the car and place it into service. So that was one. For charging stations, which is a big one, they have to generally be placed in service by June 30th of 2026. What do I say about that? Well, I think there's a lot to say about that. So oftentimes when you're dealing with charging stations, you are saying, well, I have the whole charging station ready to go. Is that deemed placed in service? If, for example, the external electricity company hasn't connected it yet. And that's where I think the proper tax planning occurs. That's a great question. And the answer isn't always yes or no. It's a fact and circumstance determination. And if you are if you're already in the business in which you're using the charging station and you solely are waiting for that outside electrical provider to interconnect you, you should be pressing like, what is that? Could I argue I'm placed in service? So that's another great question. A lot of the personal clean energy credits went away. And then we can move into things like what we would call the 45Y, which is the production electricity credit, and the 48E, which is the investment clean electricity investment tax credit. I would say 48E got kind of shuffled. Two things I would throw out to everyone. If you're involved in a solar project and you do not anticipate that it will be completed by December 31st of 2027, you need to find an advisor quickly and make sure that you are aligned so that it doesn't have to be. And this is something I have seen um, spoken about erroneously as well, is that when that date applies of when you have to meet the start of construction, that is definitely not necessarily on July 4th of the day the bill went into play. So there is some room to still meet the start of construction. As you may or may not know, solar and wind were the ones under 48 that they kind of pushed back on, and they said, okay, to the extent you haven't started and you start on Y, we're going to force you to complete it by December 31st, 2027, instead of 2033, or that particular extended date for everything else. Other things that are embedded in there that you'll try to avoid before year end is material assistance from a FIAC, a foreign entity of concern, comes into play in 2026. FIAC, right? Ownership comes into play in 2026. And so all these different items, right now we're kind of feeling the rush of clients really working to make sure that they avoid having to deal with that requirement in the following year. Okay, we are done. I apologize. I'm supposed to be done at 2:10, but I had a great time with you. I appreciate all the questions. I am around along with all my Withum brethren to help you through this process. And while it might be you think it's never ending, the tax law is going to consistently change, I would agree with you. We are here for you, and we will work with you to make sure that we are doing it in the most idealistic manner and most efficient manner for you and your company. So thanks for having me on today, and I hope to speak to you soon. Take care.